Good afternoon, everyone, and welcome to Vantage Markets Australia's The Monday Open. This is our regular Monday webcast that we do, wrapping up last week's trade, previewing this week's trade, and looking at a little bit of technical analysis. My name's Jeff. I'm in Vantage's Sydney office. I'm usually joined by Mark, who's in the Melbourne office, but he's off the desk today, not feeling quite well, so that's all right. I can carry. So let's get started right into it. So, as I said, what we're going to be doing is running through some of the events from last week that moved markets, things that I see that are coming up on the calendar this week that actually might be triggers for trading opportunities. We'll go through some technical analysis, and just as a bit of a spoiler alert, this week we're going to do dollar yen and Bitcoin, and we're going to answer some questions as well. So last week we saw Australian CPI come in lower than expected. That came in at 2.1%. The market was expecting significantly higher. I think it was 2.6. It didn't really have very much impact on the Aussie. I think most of the players in the Aussie dollar are pretty sure that the RBA has put the queue into the rack and they're waiting for early next year. I know all of the big four banks are still not expecting any sort of move before February. Just remember the RBA doesn't meet in January. So they've got an opportunity this month, and then it will be all quiet on the RBA front until the second Tuesday of February. The Reserve Bank of New Zealand, however, did cut their Kiwi interest rates by 50 basis points. That was as expected, and it was so as expected that the Kiwi actually firmed off the back of that news. It's not often that you see a currency increase its value when they cut interest rates, but that happened last week. It was in the midst of a bit of a thin day in terms of volatility, but the Kiwi did noticeably improve, rose about 25, 30 basis points, which is really quite good for a currency move on a day of a rate cut. And the last one from last week was the US GDP. The GDP came in bang smack exactly as expected at 2.8%, and markets yawned. So what we're having with markets at the moment, there's an old saying for old brokers that between Thanksgiving in the States and New Year's, not very much happens in the market. There's a very good reason for that. The guys that have actually made money are sitting there counting their bonuses for year end, and they don't want to risk losing any of it. So they're pretty much just sitting there making prices as they have to and closing off trades as quickly as they can. They don't want to carry any risk. The ones that are trying to increase their risk on their books at the moment are probably guys that have missed or just been a little bit shy of their bonus, and they're trying to bump it up in December just before the end of the year. So that's what we're expecting. Well, that was what last week was. This week is a interesting week because it is all about US jobs numbers. So we have the JOLTS job openings report, which is a private sector jobs report that happens on Tuesday. Not usually very market moving, but is generally a little bit of a good precursor for the payrolls. Excuse me. On Wednesday, we have the ADP non-farm employment change. That is also a private sector survey of employment in the States. That started off, I remember when it kicked off about 6 or 7 years ago, it was really quite different to what the non-farm payrolls number was, but they're lining up pretty well these days. So Wednesday will be a good precursor to Friday, which is the headline non-farm payrolls number out of the States. The market is expecting a 202,000 increase in payrolls. That's 202,000 people with jobs that didn't have them the month before. Last data was weaker than expected, and this year we haven't had two numbers that were weaker than expected in a row. So, being a bit of a gambler broker, I think odds are that it's going to be strong. A strong non-farm payrolls number would certainly support the dollar, even with guys having their fingers off the button. The common sense move on that would be to buy the dollar, simply because better employment implies strong economy. So on the technicals, and this is where I should share my screen, so bear with me for a second. I wanted to run through a scenario where you've just had 2 or 3 weeks off, you haven't traded, you had a bit of a trading break, and you're coming back to it with positions flat and just looking to place that first trade to get back into the game after a bit of a layoff. So I always look at dollar yen first. I think dollar yen is a really good indicator of what's going on in the currency markets, mainly because it's got the dollar in it, which is the biggest part of the currency market, but B, also at the moment, especially, you've got the Japanese government, or the Japanese Ministry of Finance, looking to raise interest rates while America is cutting interest rates. So what's going on there with that differential in the interest rate would have more of an impact on this particular currency pair than any other. So I would zoom out and have, I know you people are all going to be saying, but I'm day trader, but just bear with me. We start off with the monthly, and we see that, pretty much from, what's that, 2001, so we're talking 2 years, it's pretty much done nothing but go up. So it's fair to say that the long-term trend is upwards. We had this high here. That was the recent high. That was, let me see the number with my old eyes. What is it? Is just shy of 162. So that was the high. A lot of people in the market were expecting, just as an anecdote, the BOJ or the MOF to come and intervene in the dollar at various levels above about 150. 150 was always seen as a pretty good, strong resistance level, and you can see that around there. But the fact that the BOJ and MOF have let it get up to about 162 implies that they're comfortable with it there, because if they weren't, they would have done something about it. So that's where we're at for the economics meeting the fundamentals. On the first thing I would do is draw this trend line in here from this low, and there. So I'm of the school of thought that trend lines don't have to touch exactly, but they have to be pretty close. We've got the original origin there. We've got a touch here, a failure here. So you could almost call that a touch. And this touch here, which came straight back down to the level and bounced straight back up. You can see that it's failed from this high here. So that was a failure high of, and remember, this is still the monthly chart. So that's last month. That's November. Failed. Starting back below at the bottom end of this here. So broadly, I want to try and take long trades, just because the trend is up until this trend line is broken in my head. So I'd move down to the weekly charts, have a look at this move here. This has had a bit of a retracement, so we'll look at the Fibonacci on that. I know a lot of my clients look at Fibonacci's, and I'll tell you guys what I say to everyone. Fibonacci works the best in the biggest markets. So my experience is on things like dollar, yen, euro, and gold. Fibonacci works pretty spot on. And gold in particular, the Fibonacci likes the 50% retrace. But we've retraced already so far this month 50% of this big move down. So we've come up, we've broken that up, and we've come back down and found support at about that 50% level. And you can see that was support here as well. And it was mild resistance here too. So we're looking at support levels. We're looking at, we still want to be long. And now coming back down to the dailies, we can see that this is a very sticky sort of level where it's stopped and turned around here as well. I would probably want to trade dollar yen from the long side. So in my head, being flat, I want to come here, and the first thing I want to do after deciding what direction is to decide where my stops are going to be. That is decision number 2 for me. Where are my stops going to be? So this double bottom here seems to be important for the time being. I think a logical place to place stops for any sort of long trade at the minute would be below that level. For me, I usually work with a 2.5 to 1 risk to reward ratio, or reward to risk ratio. So I want to get as close to that stop level, excuse me, as I possibly can, because I'm cheap and I want my stops to be small, and then look to trade the long. Having said that, my target for the long is going to be somewhere shy of this. I don't like trading into highs. Those that I've spoken to on the phone will know that I like to trade breaks of highs, but I don't like to target a break of a high on an existing trade. So for me, I'm going to want to find out what that distance is, work out about 2.5 or maybe even 3 times, and then take the target that level there. And I think, you know what, that level is going to come in at around that 61% retrace right there. So that's the way that I look at markets in terms of how I want to place trades. The other thing that I always do that, because I do carry trades overnight, I'm not one of those ones that worries about swap fees. I like to look for that kind of swing slash middle term trading. I like to look at my trades every morning. If I was flat, would I still want to be in it? So that's kind of the big overview for me. If I was flat, would I be comfortable taking this trade again today? So for me, it's all about little risk and bigger return. So as it's holding above those lows, I'd be comfortable to be long. Um, if it breaks that level, I'd want to reappraise, but that's where I'm at. And then obviously reappraise every morning with, if I'm flat, do I still want to be in this position? As it bounces back up and tests higher, I would increase my stops, as you would have done here if you were lucky enough to get that low. Increase the stops to the swing low levels. I think those swing low levels, pivot areas are really important. Markets stop there for a reason, so let's respect that reason and understand that if it turned around there before, it'll probably turn around there again, just because that's where, logically, that's where the professional traders like to place their orders. The next one we want to go through is Bitcoin. We now, historically, I don't really look at the Bitcoin against the Aussie dollar. I think the market number for Bitcoin is so out there in the public domain that Bitcoin versus US is kind of the way to go. And just as a I guess an interesting fundamental adjunct to the way that Bitcoin works is that for the last 5 or 6 years, people have been talking about that 100,000 level on BTC US, which it's just failed just below. What's going to happen when it hits 100,000 is that all of those people who are targeting that level are going to have their pending orders become market orders. So they could get filled anywhere on that move down. So there is going to be a massive amount of selling, in my view, as soon as that 100,000 prints. And there are a lot of people who think they're going to get out at 100,000 who aren't, because they're going to get slipped. It's funny that this is a daily. We've had that move up. We've had the consolidation of the move up. Price rejected that consolidation pretty hard and bounced up pretty hard. But we've had these really quiet days now. So what this is, if you think of the market as a spring, and if you push a spring together, it's coiling and it's waiting to explode again. Honestly, looking at this series of higher highs, series of higher lows, it looks like it wants to go higher. I would just be very nervous at that 100,000 level, because it's such a level that people have been talking about for so long and so hard. I think that when it does trigger, there might be a little bit of a reaction. For me, I'm comfortable, again, below this low, being long, but I wouldn't want to target a break of that level. So as price dribbles off and gets closer to this kind of area, I think, it might make sense to take a stab at it. And again, this is the daily chart, so that's a pretty big move. I mean, if you were to get them around here with stops down here and target a move back to even a test of this high, I think that's, that would be a nice way to end the year for most traders. That would be it on the technicals. And we can go into some Q&A. So on the Q&A side, we had 2 of them this week. I'm new to trading. Where do I start? There's a lot of stuff on the internet, and I think most people go down that vortex when they kick off. And I just think it's a little bit nervous, because you're reading information about something that's really quite important and quite technical, written by someone, honestly, quite frankly, who doesn't really know what they're talking about. What I like to suggest to people when they're new to trading and they really want to have a good crack at it, there are 2 very, very good books. One of them is called Trading for a Living by Alexander Elder. That book is pretty much 200 pages of risk management. Alexander Elder was a psychiatrist or a psychologist. I always get those mixed up. My wife, who is a psychologist, she says that psychiatrists can prescribe drugs and psychologists can't. She says that's the difference. But he was a psychiatrist or a psychologist that had a practice on Wall Street. So he found a lot of his clients were stock traders who came into him with the same sort of problem. So he specialized in that area. He surveyed a lot of guys and learnt a lot about trading, became a trader himself, and deals with a lot of the common psychological issues about risk management and about placing trades and fear of placing trades and the yips and all that sort of stuff. That's book number one. Book number two is one that I like by Curtis Faith called The Turtle Trading Method. I could do a whole 1 hour on that one. That's a really, it's a reasonably old book. I think Wikipedia has a pretty good entry on the turtle traders. That system is a little bit dated now, but it's a very good book for learning the components of a system. It was when it was released, it was Richard Dennis's system who traded futures, and it had a lot of information about how to place stops, how to place take profits, how to fan into and out of trades using ATR, which is the average true range, position sizing, all of that sort of stuff is wrapped up in that book. I honestly think that if you read those two books to start off with, you're probably ahead of at least 80 or 90% of people who don't. I think that's a really good place to start. Question number two, what time frame should I trade? Now, that's a very personal question, and it really depends on what I like to say, how much time and how much mental capacity do you have for your trading. So if you're someone who can only trade when they finish up from work before dinner time, you probably don't really want to carry your positions overnight. That kind of time for us in Australia is early to mid Europe. It's a good time to trade because the markets are moving and it's interesting. But in terms of time frame, I think you should be looking at the daily, the hourly, and the 15-minute charts for that sort of period. If you're trading early morning in Asia, you want to keep your trades pretty short just because early Asia can be a little bit jumpy because the liquidity isn't so great here. So I'd be looking at, again, the 1 hour, the half hour, and the 15-minute charts for that one. So I think that just about does it for today. While I've got you, this video or this webcast is something that we do every Monday afternoon. Again, it's just to wrap up last week's trading and look into what's key for this week's trading. This is the kind of thing that I used to do when I traded professionally back in the day. It's a really good way to wrap up and get ready for the week. In addition to that, so this video will be placed on our YouTube channel if you want to go and check what I said next week and see if it was right. And it will also be uploaded to our VIP trading room. So our VIP trading room is staffed by Mark and myself when we're in. And so you can reach out to us there, send us a message. You can send us charts to have a look at as well. And it's also staffed by some analysts from the Everest Fortune Group, which is a Southeast Asian-based analysis company. They work with hedge funds up there in Southeast Asia. They can answer some questions for you guys as well, and they provide a little bit of analysis too. We also, in terms of content, have our weekly technical video, which is posted every Friday. That's a really good one for just having a really quick comb over the markets to see what's going on. Obviously, no advice, but the people who do those videos will show you the way that they're looking at markets as well. And finally, we have our private client daily update, which Mark and myself, the private client team here at Vantage, we write that every morning. That's emailed by 10 to 10:30 Eastern Standard Time. And again, it's kind of the daily version of this that's in text. So we wrap up what happened the night before. In terms of markets, we show or we indicate what we think are going to move markets today or that day. That can be received via an email, or we also upload it to our trading room in the morning once it's ready to go. If you want to be added to the email for that, just please reach out to Mark or myself. Everyone watching that should have one of our contact details, just because one of you is attached, all of you are attached to one of us. And that's it for today. Thank you very much, and we'll see you next week.